right, so here we are with Chapter 9 and Chapter 10 exercises, petty cash, bad debt, interest, and bank reconciliation. So we get to take a look at extra examples. So let's go ahead and answer question number 1, okay? So on January 1st, you opened up your store and needed a petty cash fund, okay? So in this case, for emergency expenses, okay? So you established the petty cash fund for $500, and it should be enough for those first month, operations. So how do we journalize this?
Petty cash, 500.
Good. Petty cash, 500. What else?
Checking.
Yes, checking. 500. And once again, if you would like to make a description here, you could say to establish petty cash fund. Good. All right. So then question number 2 says, okay, at the end of the month, okay, you counted all of the receipts in the petty cash fund to be, you had a total of $40.03 in cash remaining, and where's the rest of my information? Oh, and down here is your petty cash fund. So here you have a total of $40.03 in the cash remaining. Now we need to replenish the petty cash fund. So how are we going to do this? What was the total amount in my receipts? Okay, and what is my total that I need to do to replenish? How do I replenish my petty cash fund?
You're gonna checking for $456.95 and add that to petty cash, and
Okay.
add that.
You got the checking correct. Okay.
You're gonna debit the checking.
No.
Uh-huh.
We're replenishing the petty cash fund. So are you going to be adding money to your account, or are you going to be taking the money away?
You take it away, but you're going to add it to petty cash.
No.
No.
If you add more money to the petty cash fund, what are you essentially doing?
You're increasing it. That's right.
Correct. So in this case, how do we replenish the petty cash fund?
Write a check.
Write a check. For what?
When you tally up your receipts and totals, and if they're all correct, write the check for that amount.
Correct. Now let's take a look at our expenses right here. So here's our petty cash drawer, or our person who took inventory, or records of who took the money out and what was it for. So here, let's take a look at each individual transaction. So here, Drew, okay, decided to take money to buy office supplies, okay, for $20. And then we got Susan, who did a business expense for $60, okay? But then again, they just took the money out of the petty cash fund. In reality, they came back and said that, okay, well, my receipt was actually for $19.85, and I gave 15 cents back to the petty cash. So therefore, I should have a remaining of $480.15. Okay? So once again, this is just a ledger. Okay? It gives you your total receipts here, but it also gives you the total balance at the end of the day. So here, we for surely have a total of the $500 transaction. Felipe, how much was the total receipts?
$456.97.
Okay. So it's going to be $456.97.
Should
So
it be on the one over?
this is the total that they took out from. Oh, yes, thank you.
Oh, yeah. I was like, wait.
You're right.
Did
You're
my math wrong there.
right. You're right. You're right. You're right. You're right. My bad. Okay. So yeah, 456.97. Good. So that's how much your total receipts are. So that's the amount that you're gonna write your check out for. However, how are you going to distribute each or reimburse, or in this case, replenish the petty cash fund? What are you supposed to do? If I bought all this stuff during the month, did I ever recognize it?
No, just on this ledger for the petty cash.
Exactly. So when you when you replenish the petty cash fund, essentially you're recognizing every expense that occurred by paying for it and putting the cash back in the drawer. So in this case, I have office supplies expense, I have business expense, I have meals expense. All right, I got delivery expenses. Okay. So in this case, we're going to actually have to go through each and every single one and tally them up. Now, just to save some time, well, actually, let's just go through every single one. So what's the first expense that we encountered?
Drew, buying office supplies, we're giving $20.
Okay. So office supplies expense is something that we're going to recognize. Okay. And we gave him $20, but how much office supplies did he actually purchase?
$19.85.
So here we got $19.85. Okay. What else happened? What did Susan get from us?
Expensive lunch.
What,
I mean,
A business
Susan.
expense.
just a random business. We don't know what it is. But how much was the total expense for?
5417.
5417. So here we need to recognize that we had a business expense, right? For 54, what was it? $54 and what? 17. Okay, I was right. 5417. I don't know why I didn't trust my stuff. Okay. What else happened?
meal expense.
We got meals expense. That means someone decided to pay, the boss decided to pay for lunch. How much?
$35.22.
$35.22. So meals expense. Okay. For 35 and 22 cents. Okay. What else happened? I guess Susan bought another meals. For how much?
$15.67.
$15.67. So in this case, we need to add together 35 with the, what was it, 15.17?
67.
15.67. So what is 35.22 plus 15.67? Because we have to add the totals up, right? Because the essentially meals expense, right, is a general account. So anybody can take meals expense out. So in this case, what's my total meals expense?
$15.98. What? Can we see that? Can you scroll up again? I think I messed up.
So we got 35.22. Okay. 35.22 plus 15.67. $0.89. Okay. 50.89. Okay. What else has happened? What did Harry encounter?
Delivery expenses.
Yes, so maybe somebody shipped us a package and they expected us to pay for the delivery. So in this case, Harry had delivery expense for $50. Okay. What else happened? Harry borrowed more money.
Another business expense.
Another business expense for how much?
So we're in the 54.17 plus Harry's business expense now
Mm-hmm.
plus 50.
No,
So
no, no, not 50, 22.78. That was the delivery.
sorry. So we're gonna add the first one that we had plus the 22, which brings our current total up to 76.95.
Yes, 76.95. For business expense, 76.95. Okay. What else do we need to recognize here? So what happened next? So then Drew once again bought more office supplies.
So I'm gonna update the officer price by $6.95.
Mm-hmm.
That brings it to $26.80.
$26.80.
Yes.
26.80.
Yes.
Okay. Okay. So now that we have office supplies expense, what else? Mary. What did Mary encounter?
And delivery expense for $100.
Okay. So.
So it's 150 now.
Mm-hmm. Okay. What else did we encounter?
Advertisement.
We got advertising expense. So someone decided to go take money out to go pay for the advertising. So in this case, how much was the advertising expense for?
$50.
$50. So we have advertising expense. Oops, it's S. Expense, $50. Good. All right, what else happened here on January 22nd?
Owner's withdrawal.
Uh, the 22nd,
I'm sorry, delivery expense.
we got another delivery expense for $25. So
That'll take it to 175.
175. And then what happened on the 27th?
Another business expense for $30.33.
So $30.33 for business expense. So what's my total here?
So $33 and how many cents?
33? 33.
107.28.
All right. And then last but not least, what happened here on the very last day of the month?
Alan decided to take $50.
Okay. All right. He decided to take an owner's draw out, right? So here you can write owner's draw for how much? $50. Now go ahead and calculate this grand total here. What was the total amount of expenses you guys encountered?
I totaled it at 459.97.
$459?
Yeah, that's what I'm trying to figure out.
Yeah, I got
Okay.
997.
All right, then we did a discrepancy somewhere. So it could be with the
Well,
math.
you had the beginning balance at 300. Do you think maybe it's up top?
Oh, right. It's supposed to be 500.
No, you know what? My original number I gave you guys was wrong because I got 459.97 too. After you take $500 minus the, yeah. So it's yeah. That's supposed to be a 9. Yes.
Yes, there you go. So it is 459.96. And what do you know? Our total amount of expenses matched 100%. And guess what? Did we have a overage or a shortage?
No.
No, that means we're going to write a check for the total amount of 459.97 for all of these expenses, and we recognize all of these expenses. So there you go. That is how you replenish the petty cash fund. Okay, you're going to total up the amount of receipts, recognize all the expenses they were for, right? And you're going to reimburse the amount. So basically what you're doing is you're taking all the receipts, you're counting them up, and basically you're exchanging them for cash to put back into the petty cash fund. So then now for February, you have a total amount in your petty cash fund to be $500. Okay? Any questions on how to replenish the petty cash fund?
Lennon, you're gonna put this worksheet in the Google Classroom, right? Completed?
All answers are going to be on the Google Classroom. That is correct.
Okay.
Okay. All right. So number 3. Is everyone okay?
Yes.
All right. So then number 3 says that on June 1st, your business began to pick up, and then the last few months you were pretty much running low on the cash in your petty cash drawer. Okay, so then you decided to increase the petty cash by $300. Okay, so record this transaction. So how do you increase the petty cash fund?
You would debit the petty cash, right, and credit checking for the 300.
Correct, right? Because we're increasing it.
Yes, and then make a note that increase in petty cash fund.
Good. So again, we're increasing it by $300. So therefore, how much should I actually have in my petty cash fund right now?
$340.03.
Well, remember, we replenished it.
Yeah, so it'd be 800.
It'd be 800 even. Good. So remember, right? This is June 1st, okay?
Okay.
I replenished my petty cash fund, at the end of the month. So January 31st. So, let me write that. January 31st. Okay? So I put the money back into my petty cash fund, right? Now this is a few months later, and I realized, hey, my petty cash fund is not enough. So because I'm doing that, I decided to tell my boss, hey, the petty cash fund is getting too low every time. Can we increase it? And that's where you guys take a discussion on how much over you went over, et cetera, et cetera. And you guys decide that you're going to increase it by $300. So therefore, now my petty cash fund has a total grand amount of $800 in cash to make those small, minor business expenses. Okay? So now, question number 4 says that at the end of the year, you decided to get rid of the petty cash fund or petty cash drawer and start using a business credit card, okay, for all minor expenses. Record the closing of the petty cash fund. So at the end of the year, so December 31st, what are we going to do if we're going to close out our petty cash fund?
Credit the checking.
Not credit. We're not paying into it.
Debit.
We're going to debit, right? We're going to take all the money that's in the cash drawer right now, or the petty cash fund, and we're going to dump it into checking. Okay, so in this case, assuming that these were related, if I started out with 500, I increased it by 300, I should have a total of 800. Okay, and once again, note here is to close out petty cash fund. Right? Straightforward? Easy? Yes? So remember, when we close out our account, think of it as if you're physically closing it out. If you're going to close out your petty cash fund and you want no money in it, what are you going to do with that $800? You can't put it in your pocket. That would be stealing. So what would you do with that money? You would put it into your checking because it belongs to the business. Okay. Any questions for the first 4 questions? Okay. So once again, questions 5 through 10 are related. All right. Question number 5, on June 15, okay, customer A decides to purchase a total of 100 toys for $5 each, okay, on an account. Sales tax is 8.25%. Record this transaction. So, if customer A decides to purchase, what are we going to recognize?
Accounts receivable.
Accounts receivable, right? They placed it on an account. All right?
Sales and sales tax.
Sales and sales tax.
Sales tax is $41.25.
41.25.
The sales was the sales was for $500.
Right? 100 times 5 is $500. Good. Tax is based off of the $500. So in grand total, how much does customer A owe us?
$541.25.
54125. Okay. So once again, I'm going to make a note here just so that I can verify that customer A purchased 100 toys. Okay. Right? Again, we're not focusing on terms or anything like that. So in this case, or inventory itself, we're just focusing on the accounts receivable aspect. So in this case, we don't need to do anything else. Okay. So then, question number 6 says that on July 15, we received a payment check for $50 from customer A. Record this transaction.
Checking.
Checking. Good. We received a check, right? Therefore, it's not cash, but it does go to our checking account.
Accounts receivable.
Accounts receivable. Okay. For how much?
50.
$50. And here, what are we going to make a note? We're going to make a note saying that we received payment from customer A. Okay. Right? That's what we did. We're recognizing that we received money and we're going to reduce the amount that this customer owes us. Now, if the customer owes us $541.25, they only paid us only $50. So you're going to automatically assume and collect the money because you never know what's going to happen to customer A. So let's see what happens to customer A. On August 15, customer A refuses to pay for the remaining amount that she owes us. Okay? So how do we record this transaction?
I remember this term from yesterday. I just can't bring it out of my mouth.
Okay? It's okay. Take your time.
doubtful. No,
You got it? Yeah, doubtful. What?
doubtful. I want to say collections, but I'm trying to go through my notes.
Collections can be
That's
used. But in this case, what was my generic account that I called this?
um, allow.
Okay, good. Allowance.
It's not doubtful allowance. No, I'm not. No, I'm taking
No, you got the allowance part. Allowance for.
Allows for doubtful accounts.
There you go.
Oh,
Good.
yeah.
Good
Yeah,
job. Good job. You got it. You got the general
it's in my
idea.
head, but yeah.
So good. So allowance for doubtful accounts. Okay. Now, what are you going to consider the what are you taking out from? If customer A decides to refuse to pay for what they owe us.
You want to take out your accounts receivable where it's at.
Correct. Accounts receivable. Okay. Now, how much am I going to be taking that out from?
So he gave us 50, so we're going to end up with $491.25.
$491.25. 491.25, right? And we're gonna say right here, let me see, to remove customer A accounts receivable balance, right? To remove the debt that they owe us, right? Now the question is, what about sales tax, right? When you remove it into the allowance for doubtful accounts, the one thing that we know that is we never received the sales tax in the first place. So there's no point to have to take it out, because what is a possibility if we decide to put this in the allowance for doubtful account? Therefore, the customer has potential or could possibly pay for this amount. So therefore, we're not going to write it off just yet. Okay, we're not going to assume anything more except for that they owe us this, right? They may potentially pay us again in the future. So that's all the allowance for doubtful accounts is, right? We know who, we know how much, and we know when. Okay? So then let's see what happened here on the 8th, okay? We contacted customer A to retrieve the debt, okay, that she owes us. And then on October 20th, we received another payment of $15 from customer A. Record this transaction. So here, we bothered her so much to the point where it is now October. And she decided to give in and say, okay, fine, I'll give you $15. So we squeezed another $15 out of this customer. So how do we record this payment?
Accounts receivable.
Okay. What are we doing with that accounts receivable? So it's now October 20.
So we're going to,
Through in a payment, so it'll be checking.
Okay. Now where is...
so we're going to open our old account back up.
We need to reactivate her account by taking the allowance for doubtful accounts, right? Because that's right now, it's in limbo. Or in this case, we inactivated her account. So now we're reactivating it. So we have to put it back all the money. Assuming, okay, it may have taken us this long to get $15 out of her, but if we keep progressing, she might pay for the whole thing. We don't know. So in this case, we need to reactivate her account. So we're going to drop the money right back into the accounts receivable. All right, for how much?
$491.25.
Good. So 491.25, and we're going to drop this from the allowance. Okay, for doubtful accounts. Okay. All right. So then I'm going to go ahead and place it here to okay, I guess I'll just use to reactivate customer A's accounts receivable balance. Okay? I don't know. Throwing something in. That makes sense, right?
Yes.
Okay, so then now we can recognize the payment because now we actually have something that she owes us and we have the amount that we can take away from. So in this case, what is going to be my journal here? What am I going to be recognizing?
Checking.
Checking for 50.
Checking. Okay, for $15. And what else are we going to be decreasing?
Accounts receivable.
For 15. Okay, and then I'm going to write here that we receive payment. I'm going to do PMT from customer A. All right, that's pretty straightforward, right? We received a payment from customer A. Okay, for $15. All right, now question number 9 says, on November 28th, a debt collector informed us that customer A has filed for bankruptcy, okay, and can no longer pay for the remaining amount that she owes us. So in this case, how are we going to record this transaction? So it is now November 28th. Okay.
So is it still going to be a accounts doubtful allowance, or is it going to be
Bad debt.
forgiven debt?
Well,
'Cause
we're
it's not the end of
in,
the year.
it's not the end of the year. It's during the year, right? So in this case, you're correct with the first one that you said. Now that we have a guaranteed, right, from October to November, right? A debt collector has informed us that this person can no longer pay for their debt. Okay, so in this case, we need to move out the complete transaction completely out from the allowance, from the accounts receivable into the allowance, because for sure, you never know, right? Even if you file for bankruptcy, you still have the potential to still pay. Okay, now is that a guarantee? We don't know. Okay, it will just depend on that person, or if anything, if the debt collector decides to pay us, then that would relieve our debt. But most cases, they're never going to pay you. All right? They're going to say, just going to, hey, this person can't pay. So you're most likely going to write it off as a loss. So in this case, accounts receivable, right? Now this time, how much is actually going to be?
476.25.
$476.25. 476.25. Okay? And of course, to remove customers A's AR account receivable balance. Okay. Right? Everyone good with me so far?
Yes.
Perfect. Okay. So then now, question number 10 says that on December 31st, our company estimated that 2,556 of out of our 200,000 accounts receivable is to be uncollectible. Okay? There is currently a debit balance of $476.25 in the allowance for doubtful accounts. Record this adjustment. Okay, once again, how are we going to write this off?
Accounts receivable.
No, not accounts receivable.
Uncollectible debt or
Bad debt expense?
Bad debt expense, because why?
It's at the end of the year and we know that we're not gonna get it right now.
Good, but what's the key factor here?
Oh, it's bad debt.
Okay. Do we know who?
debt?
Do we
Yes,
know
we do.
exactly who?
That's-
Okay, so do we know who exactly is going to?
We know who owes us the money, but we don't know who's gonna pay us if they do.
Exactly, right? This is an estimated amount, right?
Yes.
We're going to be writing off a total of $2,556 because we don't know who is going to fault on their payment. So in this case, it's an estimated amount. So we are going to be recognizing bad debt. Right? Okay. Now, what is going to be our credited account?
Allowance and doubtful account.
Yes, because what a method are we using?
Yeah.
This is the allowance method, right? Specifically, which method are we using? Okay, so let me space that out a little more. Okay? Specifically, what method are we using? So let's take a look at our numbers, okay? The company estimates that $2,556 of a $200,000 accounts receivable is to be uncollectible. And there currently is a debit balance of $476.25 in the allowance for doubtful accounts. So what method am I using?
You're gonna give us this one.
Is it the balance sheet method?
Balance sheet method. Excellent. So, if we're using the balance sheet method, then how do we determine what our total bad debt expense is going to be for?
Well, it's the balance of the ADA for one.
What would be
Hold it.
$2,556 because the other one's just the balance. Are we going to minus the 776 from the 2,000?
Okay. So let's do one question at a time. If we're doing the balance sheet method, what are the 3 key things you need to look for? Do you guys remember? What's the first thing you need to look at?
The estimate.
Good. What's the estimate amount?
The estimate amount is 2556.
Okay. Now, what's the next thing that you need to look for?
Accounts receivable.
Accounts receivable. Okay. So therefore, there comes a third conclusion. Do we care if there's a balance in the allowance for doubtful accounts?
No, because if we have a debit and a balance of doubtful accounts, we'll add it, and if it's a credit, we'll subtract it.
Okay, so yes, we do care.
Okay.
And yes, that was correct. If we have a debit balance, we add it. And if it's a credit balance, then we subtract it. So excellent. So make sure you guys know that concept, right? If we were using the income statement, right, and we see total credit sales, does that show up on the income statement? Okay, we haven't practiced it much, but no. Accounts receivable does not exist on an income statement. So does it matter if we care about if there's an allowance for doubtful accounts or not?
No.
In that case, then no, it doesn't even matter. So in this point, we do have it does say accounts receivable. So we do care about the balance. So in this case, we have a debit balance. So that tells us to do what?
To add it.
Okay, so what's my total amount of bad debt that I am actually going to be writing off?
$3,032.25.
Okay, $3,032.25. Let's see. If you guys just do your calculation, 25.56 plus the 4.76. Good, right? Because it's a debit balance. Therefore, we need our end goal is we want a credit balance in the allowance for doubtful accounts for the total of 2,556. So in order to get there, right, if we're on the left side already, we need to add the debit side and then go another 2,556. So in this case, we add those two numbers together, and 25 plus 4 should be 29, which should then increase it. Good. So 30, 32, 25. Right? Any questions in regards to bad debt? Okay. That was a little tricky, so let's go ahead and practice more on doing the bad debt expense. So, number 11, on December 31st, your company estimates that $2,430 of its $500,000 total credit sales, okay, are going to be uncollectible. And there currently is a debit balance of $1,500. So, how do we record this adjustment?
So we will only be recording the 2430 because it's a credit.
Total credit, good.
Yeah.
So in this case, the journals are going to look identical, okay, because you're still going to be recognizing bad debt, and the whole purpose of using the allowance method is that at the end of the day, you're taking out from the allowance for doubtful accounts. Okay? All right? And like Felipe said, because we're dealing with the income statement, the allowance for doubtful doesn't appear on it, so we do not care for it. So therefore, whatever the estimated amount number is going to be your total bad debt expense. Good. All right. Number 12, on December 31st, okay, your company once again estimates that 2,430 of its 500,000 accounts receivable are to be uncollectible. And there's currently a debit balance of $1,500 in the allowance for doubtful accounts. So therefore, the adjustment is going to be
Get bad debt. Okay, so it's still in the accounts. On accounts receivable, it's still going to be that 2430 because currently our debt balance is not going to be on our. We're not going to be able to collect that, right?
Okay, so no, it does affect it. Okay, and how does it affect it? So this time, what method are we using?
Income statement method?
No.
No?
No, because what's the key term here?
Accounts receivable.
Accounts receivable. So does that appear on the balance sheet? Yes, it does. So in this case, if it's a balance sheet method, do we care about what is in our balance in the allowance for doubtful accounts?
We do, but we don't.
Yes, we do care.
Okay.
So in this case, if I do care about what my balance is, how does that determine how much bad debt am I going to write off?
You add the 1,500 to the 2,430.
Good. So that gives us a total of
3,930.
3930. 3930. Okay. So in this case, we are looking at the balance sheet method once again. So because the allowance for doubtful accounts is going to appear on the balance sheet, we do care what the balance is. In this case, we have a debit balance. So again, my end goal is to be at a $2,430 credit balance in my allowance for doubtful accounts. If I have a debit balance, if I'm on the left side, how do I get to the right side? All right, so you're going to add those two numbers together. All right, I'm going to keep asking these questions once again. December 31st, your company estimates that $2,430 of a $500,000 accounts receivable are to be uncollectible. And there is currently a credit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry should be what?
So you're going to debit 1,330 to the bad debt expense and credit the allowance for doubtful accounts? I mean, wait a minute.
No. You're right. Allowance for doubtful accounts.
Okay.
Okay.
This time, because it was credit, we just removed the 1,500 from the 2,430.
And what did you get? 1330?
Yeah, I think so.
Okay, so 24 minus 15. Is that 1330?
Yes.
Okay. Good. All right, so yes, so this time we're still on the balance sheet method. Instead, now we have a credit balance, so therefore we're already on the right side. How much more do we need to get a total of 2430? And that would be the difference between the two numbers. Okay. What?
Can you explain that one? Because I got 930.
That's
I
what got.
think so too. That's why I was wondering.
Yeah, I got 930. Yeah, you subtract them.
That's what I was trying to do. 24 minus 15.
2430.
24. Yeah, I know, but the 30 I already counted, so 24 minus 15 should be, 9. Okay. Good.
I fat fingered my calculator. I prefer Excel.
You can fat finger on Excel as well, too, so. All right.
What was I'm sorry, on the last one, what was the second allowance for doubtful account? Okay, thank you.
Yes, for the same one, 930. Okay. So, last question, but not least, okay? This time, on December 31st, your company has estimated that 2,430 of a $500,000 total credit sales are uncollectible. And there's currently a credit balance of 1,500 in the allowance for doubtful accounts. What is your adjustment?
Uncollectibles.
Okay, so bad debt expense.
Bad debt expense, my fault. It's going to be the $2,430.
Thank you, right? It is that easy, right? Because what was the key term you used?
Sales credit.
Total credit sales, right? Which appears only on the income statement. So in that point, the allowance for doubtful accounts, accounts receivable, they don't exist on those statements. So and therefore, we don't care about them. So in this case, all we care about is the estimated amount, which is $24.30. All right. Once again, please practice this because you will be tested. I may ask you all four. I may ask you only two. I don't know. All right. So it's going to be for you to figure out. So please read very carefully. And like I said, I made it super easy for you guys. All I need you to look for is those key terms. And it should be able to trigger in your mind, okay, if you see accounts receivable, we care about the balance in the allowance for doubtful accounts. If we don't and we see total credit sales, then we don't care. So in this case, make sure you guys ingrain that in your mind. We will have a practice of it on the study guide, so don't worry about that. But once again, I gave you 4 more examples. I even gave you another example in the example from above. So once again, make sure you guys practice that, okay? So here, let's go ahead and deal with question number 15. So once again, we're taking a look at simple interest, all right? I have an example here, $28,000 as a principal with a rate of 4.35% with a time of 150 days. Okay, so what is going to be my interest? Okay, so what's the formula?
$88.4.
Okay, so let's double confirm that. So how did you do that?
I did so 100 out of 150 days out of a whole year. It's up with 2.38.
Hold on.
Did I do that right?
Okay, 150 days. How many months is 150 days?
5,
5. Okay, how many months are in a year?
12.
Okay, so if you were to figure this out right here, you should be able to calculate this. So,
I got 609.
609 for the interest, or for the time, or for the total interest.
For the interest.
So, Melinda got 609.
Let's see.
What did everyone else get? So here, what are we doing? How do we calculate the interest for the simple interest?
Principal rate time. So
Okay.
I got 2,923.20 cents.
Okay. Who else wants to try? Okay. So if we take 28,000, all right, 28,000 times the percentage rate of 0.435, you should get a total of 1,218. Oh, actually, wait, I did that wrong. 28 times 0.435 should give you, 12/18. Then we're going to multiply it by 5 months, right? And divide that whole entire thing by 12. So I did not get 608 and I did not get 2000 something.
507? No.
507 is correct.
45. Okay.
Okay, I did not get 45.
I got 507.5. I don't know.
Yes, that's exactly correct. So what it did here is I just straightforward because of math operations, right? Instead of calculating 5 out of 12, right? I can simply just multiply it straight across by multiplying the whole thing by 5 and dividing it by 12, the whole thing by 12. It's still going to give you the same exact answer. Okay, even if you were to just figure this out, if I took 5 divided by 12, right, that should give you that 0.4166666667, right? I multiplied it by the rate of 0.435, and I multiply it by the $28,000, you should still get 507.50. So no matter where you calculate your time, it doesn't matter whether you use decimals. It does because you may round too early, which can pose discrepancies, or you'll be rounded off by a few pennies. But in this case, to make it easy for you, just go ahead and keep it as a fraction. Okay, just to make it a little easy for you. So here I did get 507.50. So therefore, what is my total future value?
$28,507.50.
Good. All right. Let's try the second one now. Since the second one's easier, right? You got 10 years. You don't need to convert the time here. So if I don't need to convert the time, so then what should my formula be? Okay.
$5,174.50.
47.
6% times 10.
Oh, yeah, times 10. Good. Gives you what?
308.85.
4-1. Oh, shoot. It's 5-1.
I got
Five.
$8.85.
So 5147.5 times 0.6 times 10 is, what did you get?
$308.85.
You gotta take it times the 10.
You got to times it by 10.
So 3,088.50.
Yes. So 4157 times 0.6, right? Should give you 308 times 10. Good. Excellent. $3,088.20. Okay, so therefore, what is your future value?
48 cents or 50 cents?
I thought it was 50 cents.
Yeah.
I got 3. Hold on, let me do it again. So 514750, right? 514750 multiply by the 6%, multiply by 10. Yes, you are correct. It is the 50. So here I'm going to add it together, and what is my total amount is my future value?
$8,236.
$8,256. Right?
No, I got $36.
36, my bad. I'm not hearing correctly. So 8236. Okay, got you. All right, last but not least, let's do the last one. So in this case, if I started out with 684150, okay, and I multiply that by my rate of 0.0349, okay, how am I going to determine what 8 months is?
So that's 75%. So it'll be 0.75.
Okay.
I got 17. I got $17,907.63.
Okay. Anybody else got the same answer?
I got lost.
Okay. So let's what is the formula to solve for simple interest?
Oh, I'm way off. That's the correct answer.
Okay. Anybody else that verified this or attempted to calculate this? If it's easier, go ahead and pull up a spreadsheet if you need to help calculate this. It might be a little more easier if you guys are a little more used to Excel. Okay, because you should be able to just multiply all three numbers with no problem. Okay, so let's try it again. Felipe, what was your new answer?
Well,
Wait a minute,
I was
I
thinking
have one.
like
I'm sorry.
Go ahead, Alan.
15,917.89.
Good.
Okay.
Yes, that's exactly what I got.
I did it twice because I want to make sure I've been fingering my calculator.
Okay. All right. So
yeah, the
15.
Excel is probably better. I'm trying to use my calculator, and it's like, oh no, it's not calculating right.
Okay. Don't worry. I'm doing the work with you guys too. So good. So if that's my interest, then what's my future value going to be?
$767.89.
700,000.
67 cents and then $67.89.
Start again. 700.
All right, I'll go 700,067.89.
Thank you. 700,067.89. All right. Good. Little practice with this. Pretty straightforward, right? All you need to do is just do pretty, which is your principal times your rate times your interest. Now, again, this would be a lot quicker, yes, if it was on Excel. But once again, I'm just testing you here. Okay. So once again, another set of exercises for you to practice. Okay. If you'd like to, like once again, if you'd like to use an Excel sheet, like I said, most of this work here, right? We don't need an Excel sheet. It's just only this part that may be more easier for you to compute with Excel. Okay. So last but not least, we have our last question here. So this is going to be more reflecting of what the exam should look like, just because I can't put a bunch of tables on the Orbund, as you guys know. I can only provide so much information on Orbund for you to take a look at. So here, it should look something like this. It should give you a very, very basic generic table that looks something like this. It's going to give you your cash. It's going to give you your bank statement. Okay, let me move the question over so we can see it there. So here, it's going to look like this. It's going to have your bank statement table. It's going to have your cash or checking ledger table. And again, you're going to have also your table for you to input your data on. Okay, so let's go ahead and take a look at which side you want to solve for first. So you want to do the bank or do you want to do the cash?
Bank.
Bank. All right. So first things first, once again, we're going to start off by the ending balance in our bank account. So what is that going to be?
$850.
$850. Okay, so $850. All right. What are we going to need to add on our bank side?
The checks that haven't been deposited or processed?
How could we tell that? I can't tell that by looking at the spreadsheet.
Well, first I'm asking you the question first and then I'll show you. So no, it's not going to be your outstanding checks. That's going to be what you're going to subtract from your bank statement.
You want to add
Oh,
the
the fees,
deposits.
the fees.
Not the fees.
Deposits.
Deposits. So deposits once again. So here on my check register, right? I have the deposits right here. Okay? And I have associated by deposit number. Whereas up here in my bank statement, I show deposits right here at the very top. So if I have deposit 44 and deposit number 45 that's already cleared for $250 and for $100. Therefore, which deposit did not clear?
46 and 47.
46 and 47, so 300 and 450. So here, deposit number 46 for 300 and deposit 47 is for 450. Right? So, yes. Okay, so now, Nicole, what are we doing? What do we need to do next?
The checks that have not been processed?
The checks have not been processed. So let's take a look at our check register, okay, or our cash ledger. How many checks did I write out in total?
5.
5. Let's look at our bank statement. How many actually cleared?
5.
How many actually cleared on our bank statement?
The 3?
3.
Just 3. Yes. So therefore, we're missing which check numbers?
104
104 and
and 105.
105. So now we can go ahead and insert check number 104 and check number 105. Okay, so in this case, what was check number 104?
50.
$50. Okay, what about check number 105?
125.
125. So therefore, in grand total, what is my estimated, I'm sorry, what is my adjusted ending balance?
$14.50.
$14.50. Okay. Now that doesn't mean we're done yet because we got to complete the cash side. So let's take a
25.
$14.25. All right, let's see. All right, what's $8.50 plus $7.50?
$15.50.
15. That should be $1,600. $8.50. Plus $7.50 should give you 16. Yes, that should be 16. Minus the $175 should give you $14.25. Yes, that is correct.
Oh. I subtracted 150, that's why. Instead of 175.
I see. Got you. Okay. All right. So we have an ending balance of $14.25. So let's take a look at our cash ledger. What do we need to start with?
Our balance.
Ending balance. So what is my ending balance in my cash ledger side?
1410.
1410. Okay. What do we need to add on our cash side?
Interest in the ACH.
In perfect. Interest in ACH. So how much is this?
$200.
$200 in grand total, yes. So here, I'm going to add interest to be my $25 plus my ACH of $175. Okay. Now, what do I need to subtract out from my cash ledger?
Your service charges and any like non-sufficient funds.
Good. So here we have service charge of $100. We also have an NSF fee for $50, and we actually have a return check fee for $35. So in this case, what is my total amount of fees? Okay, so I have to subtract out $100 for my service charges. I have to subtract $50 for my NSF fee and $35 for my return check. So therefore, 500. I mean, not 500. 185. Okay. So here, let's go ahead and solve for my ending balance. If I have 1419, what was it?
1225.
1225?
1425. It comes how it checks out.
1425, right.
Because we add the interest, we add the charges, and then we minus the service, the fees, and the return check, and we end up with 1425.
Okay, good, right? We start with 1410 plus, was that 200? So that should give 1610 minus 185 should give you 1425.
Oh yeah, I forgot to put interest.
Perfect, okay. So, once again, this is going to be a similar example for the exam right here. It's going to look like this because, like I've mentioned before, Orban doesn't let me do many interesting things. And how much information can I put in one question? Not that much. So in this case, it's going to look something like this. You're going to have a table just like this for the bank statement and a table just like this for your cash ledger. And you're going to have another table that's going to give you what you need to do for your bank reconciliation. All right, so use this as another example for you to make sure that you understand how to do the bank reconciliation. Once again, please use the acronyms. It's, right, if you're dealing with the bank side, you have to do dues. You got dues, okay? D for deposits in transit, O for outstanding checks. If you're dealing with the cash side, you have ifs. Ifs are your interest that you're going to collect. F stands for the fees that you have to subtract. Okay? So bank side, do. Cash side, if. Okay? Do and ifs. Okay? That's a great mnemonic device. Please utilize it. Took me a while to come up with that. I'm just kidding. But anyways, yes. All right? Any questions in the chapter 9 and 10 exercises?
No.